Ladies and gentlemen, hello. My name is Ben Leibovich with WhiteHaven Capital. This is another installment of Investors Corner. This is a series we started a few months ago, allowing us one-on-one access to our investors, our potential investors. We want to allow people an opportunity to ask questions. What we do is quite different from majority of, I think, sponsors. And folks have questions, and the folks on this call, I know Jeremy's invested with us in 3, I think, assets. So there's a lot of experience as far as WhiteHaven on this call, and yet I'm sure folks still have questions. We have Alon here, and we have Jeremy, and I will let my partners, Jeff and Tommy, do the introduction. I'll pass it over to them, and then we'll just throw it to the guys to ask questions. I'm here to answer. Tommy, Jeff?
Yeah, so Jeff and I are partners with Ben. We're also longtime friends with Jeremy. We met snowboarding probably a decade or so ago. And then we've also hung out with Alon on a couple of trips to the Mammoth Mountain area as well. But yeah, don't want to take up any more time. I know this time is meant for Jeremy and Alon to ask questions. Anything goes, so whatever's on your mind, Jeremy and Alon will pass it over to you to kick it off. To feel free to ask me, Jeff, or Ben any questions you have.
Cool. Yeah, I was kind of curious as to, I guess, what's been going on in terms of like new properties and what the market is like in terms of like getting new stuff. Because I know like right now with the whole, kind of pandemonium with the housing market, like the prices are going nuts on single family. And I'm just wondering like what you guys are doing with those multifamily stuff, like how that's been impacted.
Sure. I'll answer, but before I answer, I have to say that when Tommy said, he knows you forever and it has to do with snowboarding, every time I see one of those pictures on Facebook, I'm thinking, I can't run this company without him, so I need to get him a big-ass insurance policy, like a really big one, okay? Because there's some shit that happens behind the scenes in this thing that doesn't work really well without Tommy, and his snowboarding it gives me agita. That's all I'm going to say. All right, that has to be out there. I think let's look at construction, because at the end of the day, when you consider intrinsic value, there's a couple of different ways to look at it. And one of those ways is to look at new construction plus some sort of a risk premium because of the fact that it is new construction. And it's going to take, 24, 30 months top to bottom, right, to go through the permitting cycle and build everything. So there's some kind of risk premium that things are going to change in the economy, that things are going to change in terms of lending environment, all that kind of stuff. So you look at the price at which you can develop a property, and then you work it backwards, and you say to yourself, okay, well, if I can buy something without having to absorb that risk premium, because I'm buying an existing apartment complex with existing cash flows, they may be small, and I can amplify them, but they're present. They're not like, we're not starting with nothing and going to an architect and starting there and shelling out money and, all of that. So new construction, and then you have to take a step further. When you consider new construction, are you talking about building it, or are you talking about buying it from a guy that just built it? So to buy it in Phoenix from a guy that just built it in a very so-so location, $350,000 a year today. Construction costs are through the roof, anything from lumber to wiring, you name it. If you're in construction, anything near construction, the pricing is through the roof. Okay, they just printed $3 trillion. Minimum wage is going up because they have to have it go up because otherwise inflation is going to stifle people. So the minimum wage has to go up. Everybody knows it. Democrats know it. Republicans know it. Nobody's arguing about it. It's all political posturing. It's going up. So the cost, I mean, I can't remember last time I was able to hire anybody for under $20 an hour. Like construction-wise.
Mm-hmm.
Okay? So with that being said, you know, you tell me. I mean, what would it be? Scottsdale? New construction, $550,000 a door. Somewhere on the outskirts of Scottsdale construction, $450,000 a door. Anywhere else in Phoenix, $350,000 a door. Now, if I become the developer, can I develop it for less? Sure I can, but what kind of risk premium do I need to price in? So then, how do you answer your question? It's a valid question, but I'm answering it with a bunch more questions because I don't know the answer. Mm-hmm. Everything would be easy if we knew all the answers. We don't know the answer. So when I am taking people's money, safety is more expensive than the returns. And so from that standpoint, I would rather overpay on an existing building and value add on it, and it results in a lower rate of return that I can project, mm-hmm. but without having to price in a risk premium that I don't even understand what I'm pricing in. I mean, we may go there eventually because at some point there's going to be an equilibrium that's going to be twisted upside down, right? At some point, existing stock is just going to be, it's just going to be at such a point where we're going to say, listen, we have to develop. It's just going to be one of those. Are we there? I don't think so. Not yet. Are we getting closer? Sure, but we're not there yet. I think there's opportunities to achieve those returns with less risk.
Okay. And that is a kind of a future strategy, I guess, depending on
I think so. I think it's we were meeting a couple of months in a row with the general partner team, and we talked about that. I think we're moving in that direction. I think eventually it will happen. I think eventually, we started out with WhiteHaven Construction just doing interiors. Now we've taken everything in-house and we're doing the roofs. We're not doing it. We're outsourcing it, but we're pricing, bidding everything out. So we're developing all of those contractor, subcontractor relationships right now that eventually it makes sense because that risk premium is because you don't know shit. Well, when you know shit, then you can price in a reasonable risk premium. And we're moving in the direction of knowing stuff. I think I just said a bad word twice in a row, but whatever. People can deal with it. It's a little bit of being banned. You know what I'm saying? I mean, that's just how that works, right? I mean, Tommy just swallowed it like a big gulp. Like, oh my God, I can't believe you just said that.
Hey, I mean, the reasons why investors love talking to you is just because you keep it real. So, Jeremy, I'm not sure if did Ben answer your questions, even though he brought up a bunch of other questions.
Well, it was partially answered, I guess. Just I want to know kind of in terms of like new opportunities, like in offers you guys have been making. And
well, I mean, let me tell you. So over the last 2 weeks, we make about 3 offers a week. We've gotten nowhere in the last month and a half. I mean, we closed on Villa de la Paz about 2 months ago. Granted, so we started making offers aggressively again, maybe about 3 weeks ago. And so far, we don't have anything in the pipeline. We made an offer on a property, and Jeremy, you are in Haven on Peoria, mm-hmm. right? Which we're selling for $175 a door, I think, if my math is right. Berkadia has a property that's literally on Peoria Avenue, maybe 1.5 miles away. It's a 1983 versus Haven on Peoria 1985. There are no in-unit washer and dryers. We offered on it. Our offer was, in fact, no, I closed out of it. I think it was about 160 a door, maybe high 150s. We did not make it out of the first round.
Wow.
There's gonna be 40 offers on that property. Because people with a lot more capital than us are two things. A, impressed with the way Phoenix performed throughout the pandemic, and B, so concerned about the regulatory and the monetary policy going forward that they're deploying capital like there's no tomorrow. Like institutional fund managers, like the family office money allocation percentage-wise to real estate versus everything else. I mean, going from 4 years ago, it's up drastically. People are deploying into multifamily and people are deploying into Phoenix in specific. So most of our offers are off-market, but off-market offers are hit and miss. You know, just like us, somebody comes to us and makes us an offer that we can't pass up. Okay. But, you know, that's very touch and go kind of thing. So it's very challenging. It's extremely challenging. And we're hyper aware that you are looking for further opportunities, and so are many other investors, clearly. But you know, I'm not going to put my name on something, you know, that I'm not going to put my name on. So I think we talked about it on the last call a bit. The thing about it is that, listen, this is all very cyclical. This is what people don't understand, right? In order for me to make money for you and have some left for myself, it's got to be a great deal. And great deals are cyclical. Great deals are what defines a great deal changes with the cycle. Sometimes you buy and flip. Sometimes you buy and hold. Sometimes you sell. You know, it's just very cyclical. So, you know, our business plan works for a certain, you know, time frame in the cycle.
Yeah.
And then when that's over, we have three options: stop, go to a different location that's in a different cycle, whereby our business plan can apply, or change the business plan. I'm not going to go to a different location because you can't pay me enough to go to a different location. I am probably not going to stop unless you force me. And so the third option is you get a call from Tommy or Jeff, or get an email or call from me saying, here's what's going on. The cycle has changed. Here's how we got to start looking at real estate. Are you in or are you out? Do you want me to go or do you not? If you say yes, and when I say, yeah, again, it's all of you guys. Yeah. If you guys want to, then by all means we go. If you guys don't, I'm done. I'll go do something else.
What would you do?
I don't know.
I think
but I'm rich, so I don't care. I still have my portfolio in Ohio. I can always pay it off. I've got some cash flow. I've got some, you know, it's not like really an issue for me. Like if I stop, I can stop. But I do this for personal growth reasons, more so than money or anything else. Like we've never been able to do a deal without tweaking the underwriting and almost rewriting it in so many ways. Every deal, because Phoenix is evolving so quickly, the cycle is evolving so quickly. That's why we do it. It's fun. That's what makes it fun, is being able to understand our place within a really quickly evolving cycle. So if I can't find a deal, I put it on myself. It's because I don't understand something. It's because I'm not approaching it in a sophisticated enough fashion. The market is telling me something and I'm not hearing it. And I got to try to figure out what it is. Maybe I can't, and then I'm done. But that's what makes it fun. It's like, engineering. You're solving that problem and you're always chasing it. But I have to believe that I can solve it regardless of the cycle, because we're chasing the delta. I'd like to believe we can solve it. And then eventually the cycle changes, and guess what? We get discounts. So we become a different kind of player, different kind of buyer.
Mm-hmm.
Right? So, it's not all black and white and gloom, like, oh my God, the market's too hot, you can't compete. All I need is one good deal a year. I mean, that's my job, to get one good deal a year. If I get more than that, fantastic. The challenge with that is to have the money, the investment capital, ready to deploy when you finally do get that deal. Because there's opportunity cost in it for you guys.
Yeah.
You can't just sit around and wait.
Right.
So
what has been working with this cycle, this current cycle? What has been successful versus other times?
Well, right now it's all about value add, but we're running very low on value add. And we're trying a couple different things. A lot of the offers we're placing are different kind of offers on different kind of assets. So I'm not going to talk a lot about that because it's half-baked at this point. We're just trying to find angles. But we're still all about creating value. I don't feel safe necessarily in a deal unless we're buying Class A for asset preservation purposes. And we don't really care what's going to happen in the cycle because we're planning on taking FHA financing and sitting in that deal for 20 years. It's not a matter of creating wealth, it's a matter of preserving it at that point. Right now, we're still looking to create opportunities to create wealth. And I think there's still going to be ways to do it. It's just always evolving. I mean, 3 years ago, we were buying at $80,000 a door. A year later, we were buying at 90. A year later, we're buying at 120. A year later, we're now buying at 160. Tomorrow, I might bring an asset to you at $250,000 a door. It'll make sense why I'm willing to pay that because it's a different kind of game and a different kind of asset. But the whole point is we're looking for opportunity. But it's all about creating value.
And lately, so I'm coming in without a lot of context. I talked to Jeremy. I read up on the website, and it's super impressive. It's something that I've been for years sort of like passively looking at and just sort of being a fan from far away. And I guess now that you're talking about this stuff, what has, as far as the properties that you have been purchasing and rehabbing, I'm just curious, because to give you a little background about myself, I just came back from Tucson looking for properties, and we were under contract on this single family home with a really nice guest house in the back, and we found out foundation problems, and that sort of spooked us. It was a lot of money, and the cash on cash return just dropped immediately when we did the math on that. And everything's so competitive. You get 20 offers on a property right now. And so, as an investor, the single investor, I'm trying to find that deal, which is impossible. So, when Jeremy told me about you guys, that was really interesting to hear about. So I guess the question is, when you do buy the properties, like how distressed are they? What kind of neighborhoods they're in? And what is exactly, when you say you're adding value to the multi-unit property, is it something that over time you raise rents in order to sort of sponge that equity, or how does it work? Do you displace tenants? Do you raise rents? How does that work?
So, in very short terms, conceive of us as flippers.
Mm-hmm.
We're not long-term holders. We're flippers, and it'll take us years as opposed to months. But the whole point is we want to buy for less, sell for more. Then you back into what are the mechanics of doing that, selling for more. Well, you look at a multifamily property, the value is pegged to the revenue. So you're asking yourself, how can I increase the revenue? Right? And then you're saying, okay, over the next 2-3 years, I'm going to increase the revenue from here to there. So at a reasonable assumption of a capitalization rate, we're likely to have that kind of exit 3 to 5 years from now. Can we back out and subtract the holding costs, subtract the repair cost, subtract the cost of exit, subtract the fees and all of the rest of that stuff? That's how much we can afford to pay. A very, very basic flip model. You've seen the shows on TV. You know, I don't have to explain this to you. So it's quite a bit more complex, obviously, because there's more moving parts, and you're dealing with tens of millions of dollars, and it's more complex. But in short, you're buying a property that is generating $60,000 of revenue, and by the time you're selling it, is generating $100,000. You're buying a property that's generating $80,000 of revenue, and by the time you're selling it, it's generating $125,000. You're buying a property that's generating 120, 115, 120. By the time you're selling it, it's generating 165. That kind of thing. So that's your value.
About per unit?
No, that's per month.
Per month.
1,000. So going from 120,000 a month to 165,000 a month, something like that.
Ben, if I can add a little bit more color, along like some of the ways we add value is like if you look at our portfolio, we buy like buildings that are in the 80s. And so a lot of the units haven't been renovated or updated for decades. And so what Ben and Sam do, being that they live out in Phoenix, they oversee the construction and overhaul of these units. So we're taking, the kitchens and remodeling them with stainless steel appliances, adding in granite countertops, adding in new cabinets, redoing the floors, and then, adding things like gyms and making the overall apartment complex have more curb appeal. And so by doing some of those things, we're able to drive the rents of each of the units up. And because we have economies of scale, we're doing this for 100 units over the course of a couple of years. We're now boosting the rents anywhere from $300 to $400 per unit. And that gives us that new revenue per month, which then gives us that new valuation when we think about exit.
Right. And that's an important tidbit, since we're talking about this. You're probably going to do your research, and you're going to look at a bunch of different groups. My advice to you, anybody who tells you they're going to lower the expenses, just freaking run, just turn away, run as fast as you can. Just don't even look back. That's the stupidest thing I've ever, it's possible. It's possible. But it takes what it takes to run a property. Payroll is payroll. FICA is FICA. Health insurance is health insurance. It takes what it takes. It takes paper and staples and copy machines and ink. There's no magic to any of this. So, for people to I'm going to lower expenses as a value add strategy, it doesn't make any sense. Why would I want to cannibalize the property and risk it not performing as well because I'm not giving it enough juice with which to operate when I should be creating tons of equity on the other side, on the income side of the equation, right? Oh. So that's one piece of advice I'd give you. If you're looking at groups, really the expenses almost never should be the focus. Almost never. Like everybody likes to break up the utilities and sub-meter the utilities. Why? You can bill back 95, 100% in some cases of those utilities. Why are you going to care? It has zero impact on your bottom line. Like that kind of thinking. You know, mathematically it makes sense, right? Because NOI is comprised of two things, income and expenses. You can lower the expenses and your NOI rises, right? And you can raise your income and your NOI rises. But between the two, like expenses have almost no impact.
In the long run.
And it's dangerous because you're cannibalizing the property from, you know, blood with which to run. It's like, why would you want to hire a cheaper person to run it? Hire a better person to run it. Because they're going to be having to take these units and re-rent them for $400 more than they were rented before. So they got to know what the hell they're doing.
With the previous properties that you flipped, did you find that raising rents sort of you lost tenants? Were there vacancy? And if there were vacancy,
no, that's a simple math formula. So if you take a 100-unit property at 95% occupancy, which is stabilized occupancy, let's just call it stabilized occupancy. So 5% occupancy means you're getting 5 units a month that are cycling out. They're moving. Well, 5 units a month is 60 units a year. Over the course of 2 years, you're blowing through the property without forcing anybody out, just on a normalized, stabilized operational basis. So, yeah, I mean, what we do, that's a good point. What we do is called repositioning. A lot of people talk about it. But what most people do is they will buy an apartment complex, they will paint the cabinets, they will maybe replace the doors, they'll refinish the Formica countertop, and maybe replace some appliances. And they will raise the rents $150. What you are doing in that case is you're not really upgrading the tenant profile. You are stretching the existing tenant profile. The people who can afford something better are not coming to this because this is just marginally better. It's not better enough to interest a higher level of tenant profile. What we want to do is we want to reposition the property so as to be able to attract a repositioned profile of a tenant. Okay? So to answer your question, yes, most of the people that we inherit will not be in this property when we're done. Maybe 15%. The first 15, maybe 20% of the renovated units, those people who can appreciate and qualify for a higher level product who are currently there, they're going to move into the first units because they're going to be aware of them before the rest of the marketplace. But that's only 15 to 20%.
Got it. And do you, so when you do raise the rents on, let's say, the ones that are going to leave, obviously you're bringing equity, you're improving the quality of things. A lot of people are not going to be able to either stay. But I'm not really familiar with Arizona law, but by law, are you supposed to buy them out? Are you supposed to pay them to move out, or they just organically? Do
you live in California?
Yes.
You sound like you live in California.
Yeah,
See,
like
this is California. Yeah. Now, we got a bunch of Californians coming, and unfortunately, they're bringing their shit with them. Tommy doesn't want to come. I mean, he loves me, and he loves Sam, and he loves WhiteHaven, but he wants his water and his beaches and all that nonsense, and so he won't come. But
Ben, they're also bringing the valuation for our exits. They're bringing that population growth. That's
true.
Where the hell am I going to go when this place is California?
Yeah. Then you can come to California. It'll
back
be
to Russia. I mean, it's that part of it is bothersome, but it's great for business. But
It's amazing. Yeah.
we're not moving anybody out. The lease expires. Landlord tenant law is, as long as you give somebody a 30-day notice that you are not going to re-sign them on the lease, that's all that's required. That's all that's required from a tenant. That's all that's required from an owner. So if a lease expires, we're not kicking anybody out in the middle of a lease who is abiding by all of the provisions of the lease. When the lease expires, if we need additional units, and we don't always need additional units because, like I said, 95% occupancy, we should get enough units to renovate anyhow without having to non-renew. But eventually, we've made enough progress to where we have to take every classic unit. So as every classic unit expires, we simply non-renew those people. And they can move into a renovated unit if they can qualify for it, or they can move out and go find someplace else to live. But we do not break leases in order to accomplish that. That would be illegal. We simply don't renew leases.
Got it. That's interesting.
I want to be mindful of time here since I know that you're chatting with some other investors. Jeremy and Alon, any last questions?
Let's see. I have a tiny little list. Well, I know this is an ever-growing market, and again, like you said, it's cyclical. But historically, from when you started this, the length of time to see returns and the length of time to, when you do renovate and you do sell it to I guess bigger investors, what is the timeline historically, and where do you see it going now that there's an entire immigration coming from California into Phoenix, into Tucson, into all these areas? Like, what are you projecting? And obviously, you don't have the data for future projections, but what's your feeling on it?
Well, I'll answer this way. We underwrite everything to a 10-year hold. We tell people 3 to 5 years is what you plan on at a minimum. But we have done better than that in terms of the time frame. So I don't want to commit to what it's been and what it's going to be. We've been able to exit several times. We're under contract right now on one that's going to be 22 months. We sold one a few months ago that was 21 months.
Wow.
So but
right. Yeah, Canyon 35.
That's not necessarily, huh?
And then also Canyon 35 as well. That one's about 36.
Yeah, that's about 3 years.
Yeah.
It's going to be about 3 years. So, but I hate to guide you or anybody to that because obviously we've done a lot of things right, but clearly we were helped by all of the dynamics in the market. I mean, it'd be asinine for me to say, hey, we're such geniuses. We did all of this on our own. No, we kind of had the guts to go there when maybe other people didn't see it that way. That's a feather in our hat. That's great, fantastic. But we saw the cycle evolving in a way that it has evolved, and that's good on us. But it's the cycle. I mean, it's helped us. Certainly the product we're creating goes a long way to work with the cycle to position us to be able to pivot to earlier exits and things. But the fact that it's Phoenix and the fact that it's next to California and the fact that California does what it does and the fact that it's probably not going to stop anytime soon probably means Phoenix is, gives you a reason to be bullish.
Yeah. And last question. Right now, when you're looking for these multi-units, are you looking exclusively in Phoenix, or are you also looking at any neighboring cities in Arizona?
So when we say neighboring cities, mostly Maricopa County.
Maricopa
So
County.
all of the neighboring cities like Mesa, Tempe, Scottsdale, Gilbert, Chandler, Buckeye, all of those, the 5 million population of Maricopa County, essentially, we look here. We do not go down to Casa Grande, which is about 40 miles down south on 75. We don't go to Tucson at all. So we're basically Phoenix.
Got it. Okay, great. I'm out of questions. Thank you for answering.
Yeah, I know Ben and Jeff have to hop. So Jeff, if you want to pause the recording, I'm more than happy to stay. I know you guys are talking to other investors, but I'm more than happy to stay and chat with Jeremy and Alon if you guys want more color on anything. But yeah, thanks Ben for taking time, and Jeremy,
thank you so much,
Alon, really appreciate you guys coming in with questions as well.
Yeah, thanks a lot.
My
guys.
pleasure. Thank you, gentlemen. And you folks listening to this, again, hoping this was, well, I know it was hugely entertaining, but hoping it was somewhat educational as well. And I appreciate you listening, and I appreciate you guys coming on. And really appreciate it a lot, because it's, new investors, our program is so different than the vast majority of things out there. Like multifamily is like this income producing class, right? And here we are spending a half hour talking about flipping it, so completely different kind of thing for you to dive in head first. And so I appreciate you coming on. Jeremy, thank you so much. And Jeremy, thank you for your patience, your support. You're in literally 3 deals with us, which is fantastic. I appreciate that very much. Thank you for the leash that you give us to execute very dynamic business plan in a very dynamic environment. Guys, hopefully you enjoyed this. This is our attempt to open this up to allow folks access directly to myself, in this case, myself and Sam and Jeff and Tommy and everybody on the general partner at WhiteHaven Capital. This was another installment of the Investor's Corner. Thank you.